Welcome to the weekly video update, where I'll go over the action in the market for the week of August 21st through the 25th, and then we'll see how things look for the upcoming week of August 28th through September 1st. We were up on the week. All of the indexes were mixed overall. The mega caps did well, some of the bigger companies, the smaller stocks, as well as the mid cap stocks, they didn't fare as well this past week. We are turning more negative, and we're pretty much negative on the daily charts. It looked like we were turning more positive when we had a good solid update on Wednesday, but we gave all that back on Thursday and then some. On Friday, we had another update, so things are improving a little bit, but we have some pretty significant overhead resistance that I'll talk about later on. First of all, before I get started, please know that there is a PDF available in the description below each video that I post. Sometimes you might find this interesting to download the slides and the charts that I'm going through. You might be able to see them a little bit better. I have a few people that really like to do it that way. I had been doing a condensed version of the daily video, but I'm still suffering from an arm injury, so I'm not able to record the way I was before. I'm just doing all of this video one take, so you're going to get all the mistakes and the flubs and everything else as we go through it. I hope to get back to doing that just as soon as I'm able to do it, but I'm not able to do it right now. I do have a private Facebook group that you're welcome to join. Just send me an invitation and you're welcome to do that. I'm only announcing that now in the weekly video update. I don't announce this in the daily video update, and I'm probably going to change that. There will be a new poll that's posted after I get done uploading this video, and I'll go through the results of this past week here in just a moment. I really watch the YouTube comments closely. If you post something that is more of a statement that I can't really respond to, then I'm not going to respond to that. But it's okay. Feel free to do that. If you want to disagree with me or agree with something, that's fine too. What I'm really trying to stop are the garbage comments and the bot comments. Those get deleted almost instantly, and I really try to stay on top of that. Also, I post on Rumble as well. I have a channel on that platform, so if you're having trouble ever finding me on YouTube, you can try to find me on Rumble. In addition to that, I am offering a free online course. This is looking like it will be the first session Monday, September 4th. Now, I know that's Labor Day weekend, and I know that may be a problem for some folks. I put it out there if anyone had any problems with it, and I really didn't get any negative feedback about it, so I'm just going to go with that. That'll be 3 hours long, where I do everything all at once. That'll be from 12 to 3 p.m. Eastern Time. Then the following week, I'm going to do the same course, but instead of doing it all in one day, I'm going to do it Monday, Tuesday, and Wednesday, September 11th through the 13th. That will be from 12 to 1 p.m. Eastern Time. I will be going over my philosophy and my approach to technical analysis. I'll also be going through some different strategies that you might consider implementing if you're not already. And I'll also be talking about support and resistance. My intentions are to stream this on YouTube and Rumble at the same time. I've tried that before. Sometimes we can hit some problems with that. So I'm going to have Zoom sitting there ready to go if there's a problem, and we can just jump over to that. So what I'm going to do right before I start the course, I'm going to put the link to my Zoom account in the community tab on the YouTube page. I can't do that on Rumble. So if you want to join it, if we switch over to Zoom, you're going to have to go to YouTube to get the link. All right, let's go back and talk about what happened. For the week, we were up 0.82% with the S&P 500, but volume continues to be below average. We're still dealing with summer. We're dealing with vacations. We're dealing with a market that's not quite sure what it wants to do. When you take all of that together, you get below average volume. The technicals are turning more negative now. We're negative on the daily charts. We're showing some improvement after Friday's session. It looked like we were forming a base and then coming up out of that base. And we still could do that on the daily charts. We just haven't broken through some overhead resistance that I'll talk about later on. We're turning a little more negative on the weekly charts, and you'll see that as I go through this. When we look at the condition of our trend, we're starting to roll over underneath the moving average with the ADX. It suggests that we're still in a trend and the green line's still on top, so it's positive, but this also suggests that the trend is weakening. So for the week, the Dow was down 0.4%, and it's kind of the blue chip stocks, where the Nasdaq was up 2.3% and the S&P was up 0.8%. You had the Russell, the small caps, they were down 0.3%, so we were mixed. For the week, here's some bullet points. It was a good week for the mega cap stocks, but not as good for the broader market. Volume still remained below average, as I already mentioned. Chair Powell came out on Friday. This was the big anticipated event. And he said that he's trying to get inflation back to 2% and that they still have a long way to go. He said that the Fed will raise rates again if it is appropriate, which means we're watching all of the economic reports that are coming out. If they continue to come out stronger than expected, that could really spook the markets because that means the Fed is going to have to raise rates. If they come in as expected, because that's usually baked into the market already. If they come in weaker than expected, then that might be positive for the market. So we might be heading into a time where good news is bad news and bad news is good news when you're looking at the economic reports. And he didn't say that the Fed was getting ready to cut rates and didn't mention that, didn't even allude to that. And the fact that he didn't say that was not necessarily a surprise. There were some folks kind of waiting to see if that's what he was going to allude to. And there are continued concerns about what's happening in China with their economy. They've had a lot of weaker than expected reports come out. They've actually cut rates and they're trying to stimulate things over there. And we say that because they're the second biggest economy on the globe. And there's a lot of US companies that do business with China. So if they're having trouble, some US companies might have trouble as well. Here's a chart that I've been showing kind of off and on, where this is the CPI looking at the period from 1966 up to 1982. Now, for those of you that have been watching the videos that I do for a while, I like these charts, but I don't use them to make decisions. I just find that they're interesting when you try to match up what has happened before with what is happening right now. And we're going along fairly well, where we're matching up what happened in the late 60s and about up until about the mid 70s. And if you grew up in the 70s like I did, you really remember this later time when we just had astronomical inflation. Now, if we do end up following the same basic pattern, we do see inflation going down from here, but then after that, we see inflation really going up. So we'll, again, just look at this, just use it for information, tuck it in the back of our mind, and then we go look at other things to actually make decisions with. Another chart that's similar to this is the VIX, and this is taking an average from 1990 up to 2022. That's the blue line that you see right here. And then the VIX so far for 2023, that's the red line. And we've been coming down as stocks were going up. And that's typically what happens. Well, if we stay with that same basic pattern, the VIX has a tendency on average to go really up from here. And when this is going up, that typically means stocks are going down pretty much through the end, the middle to later part of October. Again, we don't use this to make decisions. We just use it as part of our overall information, knowing that, okay, we've looked at this, we know what it says, but then we look at other charts to actually make decisions. That's my approach. Here are the poll results. Going over last week's questions, many indexes are coming down to longer term support and Fibonacci levels. And I don't know why I put a question mark in there. In fact, a case can be made that these levels on Friday, August 18th, were also providing some kind of support. We've also been waiting for positive seasonality for August during pre-election years to kick in. I asked folks, do you feel, yes, we have held support and we will see a seasonal bounce? 50% said yes, where the other 50% said they're unsure the market is likely to trend sideways and be indecisive. The next question. Last week, we saw growth improve when compared to value. Again, this was a week ago. Do you feel that growth will continue to outperform? 43% said yes. 29% said growth will fizzle out compared to value and tell us not all that much that we don't already know. And then the last answer, 29% said growth will reverse and value will start to outperform growth. We're not we're kind of the middle question here right now. We have been kind of going sideways with this. There were times when it was looking better, times when it was looking worse. So we don't really know. That picture hasn't been made any clearer as of right now. Then the longer term weekly charts of the S&P and the NASDAQ 100 are below their long-term trend lines, and they're still below them right now. Do you feel, first of all, the indexes will recover and move higher? 29% said yes. The next answer, this is the beginning of a longer term downtrend. 43% said that. Then the last part, nothing has been decided yet. It's too early to tell. 29% said that. As of right now, we are below those trend lines, but we're not just screaming to the downside. I would go more with the last part, where nothing has been decided yet. It's too early to tell. And that's one of the problems with weekly charts. It can take a long time for these things to develop. Then the last question, over the last week, we've seen a potential convergence of signals to suggest that we may be approaching a bottom. And it looked like that earlier in the week. And it looked like all these things were coming together. So at the time I asked this question, do you feel that these signals will continue and a bottom will form? 14% said that. We will blow through the signals and keep heading lower. 57% said that. We may sit at current levels and go sideways. 29%. That's kind of where we're at right now. Again, it's this last part. So nothing was really decided technically. We did see some weakness. We also saw some strength that I'll go through here. Okay, now I have to get to the next slide. I didn't go through the Isabel Net blog charts right now. I want to keep this video as short as possible. I did have one that I pulled up because we're going to be getting the second estimate for GDP this upcoming week. And for the third quarter of 2023, the last time it came out, it was at 2.4%. And the consensus is the black diamond here, where this is what Goldman Sachs thinks. And so we're looking at positive GDP. The interesting thing looking forward is that we're not seeing negative GDP at all in these forecasts going forward. And that is one of the definitions, or part of the overall definition, of what a recession is. And you're seeing folks starting to shift over to this idea that maybe we'll have a soft landing after all. We have seen some weakness. There has been some problems in the market, but maybe we'll be able to avoid actually going into a recession. But there's other charts that we look at that have been very reliable in the past. They're suggesting, yeah, we will go into a recession. So again, we're just kind of at a mixed point right now. As far as the FactSet earnings blog, the Mr. Butters, I don't remember his first name, he must still be on vacation. There hasn't been a post there since August 7th. Getting into our charts and analysis, here's the weekly chart. Going back to Monday, where it was kind of interesting. The week before, the daily pivot, which is this dark blue line, that was acting as overhead resistance. This past week, for many of the days, the daily pivot acted as support. See where we stayed above it on Monday, on Tuesday. Wednesday was when it looked like, okay, maybe some good things are really starting to happen here. Maybe that bottom is starting to form, but then we gapped up. This is after NVIDIA came out with their earnings, which just blew everybody away. But we saw a buy the rumor, sell the news type of scenario where people were buying the rumor. And then when the news came out, they started to sell. And then that took us lower. NVIDIA was almost unchanged in Thursday's session, even after that blowout earnings report. Then on Friday, everything was about Chairperson Powell speaking at Jackson Hole. They liked what he said right off the bat, but we were really choppy. You can see these bars really were moving around quite a bit. We hit the daily pivot. We actually went unchanged for a while. But then after he got done talking, we spent the rest of the day actually improving. And this is kind of what helped us experience some gains for the week for the S&P. So for the week, the NASDAQ was up the most. And we had the Dow and the mid caps. They were down on the week. When we go back to the beginning of the year, we have the NASDAQ 100, and the S&P 500. They've been performing the best. And these are indexes, specifically the NASDAQ 100 and the S&P. They have the big mega cap stocks, and those have been really driving the market. But all of the indexes are still positive going back to the beginning of 2023. When we go back to the all-time high, all of the indexes continue to be negative, with the small caps and NASDAQ still leading up the rear. Looking at our different sectors, we were up on the week, so that's the way I sorted this. Where in the previous week you had energy really doing well. Well, this past week tech did pretty well, and we had discretionary doing okay. And this has been, but both of these top areas, they've been better performing sectors in the market in 2023. But then when we start to hit difficult times, they usually go down the most as well. Where you have staples and energy, which did pretty good the week before. Well, this past week they ended up declining. These are both more defensive plays, and it's kind of going back and forth as to how they are performing. Now we look at our relative rotation graph, and think of this, if you go back to your geometry class where you had x-axes and y-axes, over here in the top right-hand corner, that would be a plus plus. So that's the strongest area of this chart, where we have discretionary, which is green. Even though it's falling down a little bit, it's still the area that has been performing the best. If we drop down here, where we have a minus plus, I have to remember these myself, where we have communication and tech, they've been backing off a little bit, but they're still doing okay, but they have been weakening. Then if you go back here to the lower left-hand corner, these are the lagging areas. This would be a minus minus, and where we're seeing utilities and staples, and they've been really suffering in 2023. And then all of the other sectors do look to be showing some improvement currently. So we just look at this to kind of get a representation, not only historically, but graphically, to see how the different sectors have been performing. Then looking at the sectors for the week, we had real estate, utilities, industrials, and tech were up. The only we had a number of sectors that were down: staples, healthcare, communication, and energy. Communication's a growth area, but these other areas tend to be more value or defensive areas. Going back to the beginning of the year, we have communication, tech, and discretionary doing the best. We have healthcare, staples, and utilities doing the worst. Going back to the all-time high, we still have energy still in the lead. It's still pulling from those massive gains that it saw in 2022. And then industrials, where all of the other sectors are now down since the all-time high. Looking at sentiment, we're dripping down into the neutral area right now. Looking at the historical chart, where we had become quite exuberant here when we go above 75, and we've been falling down from that level right now. We'll have to see, are we going to continue to fall and then get to the point where people are really fearful, or are we going to be able to see some kind of a bounce from this current level? The active asset managers, after becoming extreme positive there, we've seen some really big declines over the last couple of weeks as they've been turning much more bearish. Now, we could use this as a contrary indicator because they're starting to get extreme negative. And even though they're professionals, they're human beings, and they do things the same way we do, and they're trying to beat the benchmarks. They're trying to beat the S&P, and if they're not doing that, then that puts them under a lot of pressure, and now they're doing things based on emotion rather than just using logic. Here's another look at that same chart showing how we dropped down to 34.36. On this chart, we could go down a little bit further. When we hit the low back in October of 2022, we had a reading down below 20. Now, we might have bottomed out here. We could still go a little bit lower than that, but we'll just have to see how some of the other sentiment indicators are going forward. Looking at the VIX, where for the weekly chart, it did tick down with the line chart as well as the bar chart. We did spike up a couple of times during the week, but we're still below this 20 area, which is a static number that the market has defined, that when we get to 20 or above, the market is considered to be fearful at that point, and it looks to be declining to the point where now we can see a reversal. Well, we've worked with the VIX long enough now to know that we can't just apply static numbers to this chart. It's dynamic. And so we look at it in another way that I go through on the deep dive video, where we try to see the longer term ranges of the VIX. Looking at the Ulcer Index, we are going up a little bit with fear, but we're still below the moving average. The Right-X Bear Bull ratio, when this is going up, that means these folks are getting more fearful, not giving us an extreme reading right now, but they have been reacting as the market has run into some difficult times. The American Association of Individual Investors, they had become quite exuberant about things, not totally over the top. But now that the market's been running into some trouble, we've been seeing a decline in this overall survey, which is fairly common. They tend to react to what's already happened, and they've dropped below zero. Now, another way that we can look at sentiment is comparing cash with the tech sector. Which one would do better? Would you be better off just keeping cash in your wallet, or would you be better off taking that money and sticking it into the tech sector? Well, for a long time, after we bottomed in 2009, when this black line goes down, that means the tech sector is doing really well. You have to kind of read this opposite of what your logic might tell you. When we started to run into trouble in 2022 was when this black line was going up. We have been declining in 2023, suggesting that tech is outperforming cash. It had been spiking up a little bit, but now it's turning down just slightly. So this is a weekly look at longer term sentiment gauge. Keeping an eye on the economy, we had the latest reading of the Atlanta GDP Now estimate, and we're up to almost 6% here on the high side, where we're at about 3.5% on the low side. When you look at the forecasts that are out there, the top forecasts are at about 2.5%. The bottom are just a bit under 1%, maybe 0.75% or so. But the interesting thing is here, as we're getting closer to GDP getting actually defined, look at how this range is tightening up a little bit. This blue area, it's getting a little bit more narrow as we've been going up. And that's just because we're getting closer to the real number that's going to be coming out. We still have a ways to wait for that, but they are getting a little bit more refined with their forecasts. Then here's another way to look at this, and we're seeing just a real move up here with the GDP now, almost at 6% on the high side, and that's quite optimistic for things. Then looking at the spread between risky and not as risky bonds, if we were running into trouble, this chart would be going up. In fact, we ticked up just a little bit, but we have been declining overall. Then on the bottom, I correlate the S&P 500 with this chart, and it's going up just a little bit because both of them have been going down. The S&P had some trouble, and this chart overall has been declining as well. The latest reading of the Chicago National Financial Conditions Index, we start to get nervous when this goes above the black line. We're actually below the black line and declining. Now, these next few charts have not been updated if you watched last week's video. These are the tightening standards, and banks are getting a lot more stingy with how and who they're loaning money out to, and this is continuing to go up. That could hurt bank profits because that's how banks make money. And if they're not loaning out as much money, they're not making as much profits. But on the other hand, if they're loaning out money and nobody's paying it back, they're not making any money from that either. But this just is suggesting that we're seeing a real tightening in this area. Then we have the real-time SOM recession, rural recession indicator. We're around the black line. We only get nervous when we get up to the red line, but this chart has not been updated since August 4th. The smooth U.S. recession probabilities, also not up to the red line, but this has not been updated since August 1st. The Brave Butters Kelly leading index. This had been climbing up, but we haven't been updated with any information in this chart since July 31st. So these charts are great for telling you what you should have done when the information comes out. And that's one of the frustrating things is the information is lagging here. Looking at inflation, and this is recalibrated every day, we are going to get the PCE later on in this upcoming week. We had the CPI already, and this just shows how inflation has been looking as of late. Not a real big change. We saw some movement around here when the CPI came out, and then right before it came out. But for right now, it's pretty much going sideways. Keeping an eye on the Fed. There's still an 80% chance that the Fed is going to leave rates the same at the upcoming meeting on on September 20th. Now we look at how this has changed. We're seeing a little bit more coming into the mix there's a few folks out there thinking that we might raise rates 25 basis points. That's what this middle area is. But over here, keeping rates the same, the dark area is right now. Then we have a day ago, a week ago, and a month ago. And it hasn't changed all that much. But this will really jockey around as we get closer to that meeting. Keeping an eye on the Fed balance sheet where it is declining as their assets are coming off of their books. And then this is looking at it on a year-over-year basis where their balance sheet continues to decline. All right, let's go into some of our charts. Looking at breadth, we're still above this moving average based on price and volume, even though we turned down slightly. But this chart is still positive. Looking at the new highs, new lows, we have been declining with the 4-week average as well as the 10-week moving average. We're also dropping below zero here. And it's not so much that we're seeing an expansion of new lows, it's just we're seeing a real contraction of new highs. So if the market was able to break out and go to some new highs, we would probably see this this green area really start to shoot up again. Looking at the advanced decline ratio, we are above zero and advancing, both with the 19 and the 39-day exponential moving average. This is still remaining positive. Accumulation distribution. This is what I watch to get an inside scoop as to what is the smart money doing. We're still below the moving average on the daily chart, where we're still above the moving average here on the weekly chart. I would tend to lean more towards what we're seeing on the daily chart because it updates quicker. Keeping an eye on our trend, we are starting to drop below the moving average with the ADX. This suggests that yes, we're in a trend, but that trend is starting to weaken. Also, the green line is on top, but it's declining, so we would still default to the positive. Now we're seeing kind of the opposite of that on the daily charts. We're more negative in the intermediate term, and we're showing no trend at all right now in the short term. So the market is really going through a shifting process. Looking at the Erin indicator, we're still positive. The oscillator is above zero, even though it was flat. This measures the green line on top, which are buyers, and then the red line on the bottom, which is decreasing. And then the oscillator just compares those two measurements. And the fact that we're still above zero is positive. We've been pretty much going sideways on the daily chart. Now, this is kind of interesting. We're not generating a signal with the mass index on the weekly chart. We could potentially be getting close to a signal on the daily chart. We're starting to come up to this red dashed line, so I'll be keeping an eye on that. How this works is when we go above the red dashed line and then the blue line and then come back down from there, then we're looking at some kind of a trend reversal. We're not always right. This indicator isn't perfect, but there have been times when this indicator has really helped us. Looking at some different charts, here is a daily chart where we came down to this previous low, which also, if you go back to August 2022, this was a previous high. And then we started to come up out of that. And it looked like, okay, this looks like a good base. We were oversold at that time. We had a couple of good days going up, but then we came right up to the 50-period moving average. We bumped into that, and we actually stalled out at that on Thursday after NVIDIA made their announcement about their earnings. We really declined on Thursday, but we showed a little bit of improvement on Friday. So we're watching the 50-period simple moving averages, especially for the S&P, the NASDAQ, and the NASDAQ 100. It would also help if the Dow was to kick in there. We're far away with the small caps, and we're kind of right in between with the mid caps. The bigger indexes is what I'm watching for right now. On the bottom, we can see where volume has dropped below the moving average. Looking at our trend channel, we're still above the midpoint in this trend channel going all the way back to 2009. Pivot points. This is when we hit the top near the latter part of July, and then we started coming down from that level. Yes, these pivot points are important. The cool thing about it is we know these pivot points before the market even opens for that particular day or month. So this is something that we can actually know ahead of time. The 50-period simple moving average, we are still above based on price. The moving average is going up, even though we've seen a bit of a decline with the S&P. The long-term trend, we're still dealing with this shorter moving average based on 13 weeks, but we're still in an overall uptrend. Looking at the McClellan oscillator, after getting extreme negative, we are starting to bounce back up. That could be positive. Looking at the summation index, though, we're still dropping below zero based on price and volume, so that is longer-term negative. The Swenlin trading oscillator, we did see some improvement based on price and volume, but we're still below zero. The BPI, bullish percent index, this measures the number of point and figure buy or sell signals in stocks that make up the S&P 500. After getting to an extreme positive reading, we have been declining, but we're still above 50. It'll turn much more negative if we drop below 50. Then looking at the PMO, this is a price momentum oscillator. Starting to roll over a bit, but it's still hanging in there positive, But when you look based on price and volume, we have dropped below zero. Here's a study of the PMO. The PMO stocks that make up the S&P 500, we look at those and go, what are the percent of stocks in the S&P that have rising PMOs? It had become extreme negative and is showing some improvement. How about those stocks that are generating buy signals? We're still extreme negative here. What about the percent of PMOs that are even above zero? That's continuing to decline. So with this momentum oscillator study, we're showing more weakness, even though we saw a little bit of improvement with the rising PMOs. The Bollinger Bands, we're not getting a signal from this right now. This measures when we go outside of the upper or lower Bollinger Band. So the percent B is what we use to measure that. Not really telling us much. We're tending to lead a little more positive on this because we're still above the midpoint of the Bollinger Bands themselves. Looking at all of our different oscillators, in the short term, we're starting to turn down. Intermediate term, starting to roll over. We're still looking positive in the long term with our oscillators. The Chaikin money flow. This is another measure of what's the smart money doing. It's declining. It's showing a little bit of improvement after going negative on the daily chart, where we're coming down here on the weekly chart. The Chaikin oscillator is below zero and declining. That's negative. The force index ticked up just a little bit and is barely above zero. That's slightly positive. The money flow, after being extreme positive, came down and did bounce up this past week. And we're above 50, so that's positive. The rate of change going back 1 week, we're above zero because we had an up week. Going back 50 weeks, though, we're still seeing some weakness after we topped out and almost gave an extreme positive reading. The RSI, after just barely getting extreme positive, has been coming down. We ticked up this last week. We're still above 50, so this is still positive. The weekly special K chart, we're still below the red line. We're on the daily chart. We're rolling over on the daily chart, but we're still above the red line. The Stochk RSI is extreme negative, so that could give the market some support. And the Williams percent R is above 50 and advancing slightly, so it is more positive. The ultimate oscillator is below 50, even though it ticked up. That's negative. The vortex shows the green line was pretty much flat. The red line is starting to increase. We still default to positive because the green line is on top. The Copic curve is not giving a signal right now. It does that when the black line crosses over the red line. Longer term, we were holding up against this 10-week moving average here, and we fell down a little bit below that. And that would equate to about a 50-period moving average, but we're not really breaking down all that much right now. We haven't come down to this other moving average. We're still well above these Fibonacci retracement levels. And then the really, really long-term trend is this green moving average. This is a 200-week moving average. And we tested that back in 2022. We're still quite a ways away from that now in 2023. Our different charts looking a little more negative with the Heiken Ashi. We're still positive with the Kegi. The Renko is still positive. The three-line break is turning a bit more negative. This chart has two different things. We have equivolume on the top. When it's green, that's positive. When it's red, that's negative. The thicker these bars are, the more volume went into that particular move. Well, the bars are not very wide right now because we've been below average. If you look on the bottom, I mainly pay attention to the 14-week where we are coming down, but we're still above zero. So we're positive, but showing some weakness. We didn't see any changes in the point and figure chart. No new X's or O's were drawn. We don't have a signal that was generated. Our different trading systems, we're switching back to neutral now after being negative with the Elder's Impulse system for the S&P. Now, we switched back over to positive with the parabolic SAR, and we've been that way for a few days now, where we're still negative when we look at the weekly chart. So these signals are not confirming each other. The PPO studies, and I've been showing this in the daily videos, seeing a bit of a decline in the long term. We're showing more of a decline in the intermediate term. We're showing some improvement in the short term, but we're still below zero. And then some daily charts where we broke below this intermediate term trend line. It looked like maybe we were going to give this a run, but we never got even back up to that level now, and we've been pretty much chopping sideways. The 50-day cycle, that started on August 1st. It will end on October 11th. We were going up pretty good at the end of the previous cycle. We've been running into a lot of trouble so far in this cycle. Then a daily chart of the Dow against the transports. When this is going up, that means the Dow is outperforming. When this is going down, that means the transports are outperforming. It does the economy better if the transports are doing well. And they had been outperforming as we were declining, but we're not really seeing that follow through right now. We're also keeping an eye on the daily chart of the NASDAQ fib levels. We came down to the 50% retracement. We've not been able to get back up to the 61.8 retracement. We're kind of in between right now. If we fall, will this area provide support? If we go up, is this going to provide resistance? If we can break out to the upside, that would be positive. If we break to the downside, that would be negative. We're also looking at overhead resistance on a daily chart of the NASDAQ 100. We have a pivot level, we have a previous high, and we have resistance right here at where the moving average is, where we topped out at this level and we came back down. We're below this level. So we're dealing with the 50-period moving average on the S&P, also with the NASDAQ 100. Then some broad market measures. This is seasonality. For the month of August, we're up 44% of the time, and we ended up being unchanged according to this. Where September, we're up even only less at 25%, and we tend to be down 4.1%. Here's just a chart of the S&P, the mid caps and the small caps with no studies on them, and we're not seeing anything all that out of the ordinary right now. The Dow continues to be in an uptrend, and it's still battling its 13-week moving average. The NASDAQ also battling its 13-week moving average, but still in an uptrend. NASDAQ 100 also on the moving average, but in an uptrend. Mid caps chopping around a little bit more, but still in an uptrend. Small caps just generated a recent golden cross on the weekly chart. Even though they've been chopping around quite a bit, it's still positive as far as our trend is concerned. The NYSE also continues to be in an uptrend. All stocks ticked up just a little bit, also in an uptrend. The 30 biggest software companies came all the way down to their longer moving average based on 50 periods, which would equate to a 200-day moving average. Are we going to find some support at this level and be able to bounce back up? In the meantime, we're still in an uptrend. The FANG index, on the daily chart, it's battling its 50-day moving average. We're also coming up to the 13-week moving average, which is kind of close to a 50-day moving average. It would be a lot more positive if we could close above this blue line. ARC is still in an overall uptrend, but seeing some recent weakness, and it's battling back on its 50-week moving average. Keeping an eye on the banks, where we did not have a good week for the banks. We dropped below 50 with the RSI. We dropped on price. We're still positive with the MACD, but now it's starting to roll over. The deposits in commercial banks did tick up a little bit in this latest reading. Looking at the Dow, the transports and utilities, we're holding up a little bit better with the transports. We broke out above this previous high, and so far we're still above that, where we've been coming down slightly with the Dow. The utilities have been showing some more weakness, which often gives good support to the S&P. We're just not seeing any follow through with that with S&P price. Some broad market measures. Here's the CRB index, and it looks like we could be getting ready to see a golden cross with the CRB index. Oil, after getting up to the mid 80s, is now dropped below 80 and is currently at 79.83. Copper, chopping all over the place, getting close to a death cross here, but it's still positive for right now. The dollar, after dropping below 100, has just been bouncing back, and we're starting to see a golden cross longer term. Now, we're not seeing that on the daily chart because these moving averages are pretty close to each other on the weekly chart, where they got a lot further away on the daily chart. The gold, looking at gold, we're still in an uptrend, but we've been seeing some weakness. With silver, overall uptrend, but just been chopping all around as it decides what it wants to do. Keeping an eye on bonds, we're starting to go more negative on the weekly chart of the total bond ETF. But we're also seeing where stocks continue to outperform bonds on the monthly chart. I just keep an eye on this. This is the 1-month yield subtracting the 3-month yield. We should always get a negative result from that. A further out yield should be yielding more than a shorter term yield. But right about the time we were dealing with the debt ceiling crisis, that's when this was going all kablooey there for a while. Looking at a daily chart of the different maturities in the US, where we really dropped with interest rates earlier in the week and then started to come back up. Here's a weekly chart showing where the UK still has the highest rates, followed by the US and Germany. We're also keeping an eye on the red line here, the rising sun. That's why I made this red. That's Japan. And they've kind of got their own little story with their bond market, and they're worried about inflation. They own a lot of US bonds, so we're kind of keeping an eye on that. It hasn't really become, at least from a US perspective, a big deal yet, but that could change. Looking at some relative studies, we start by looking at an intermarket analysis chart going back to the beginning of the year. Stocks are doing the best, followed by gold, the dollar, and oil, where bonds continue to be negative. Going back to the all-time high, oil is still doing the best, followed by the dollar and gold, where stocks and bonds are still negative. Looking at some ratios between the NASDAQ 100 and the S&P, the NASDAQ 100 is still outperforming the S&P longer term. The S&P 100 continues to outperform the S&P 500. Growth continues to outperform value. And gold has been underperforming the S&P. Even though gold's in an uptrend by itself, the S&P has been doing better than gold, and we're seeing a death cross with this ratio. It's also been really struggling against the dollar. As the dollar's been going back up, gold has been going down. Bonds continue to underperform stocks, even though they're trying to make a bit of a bounce here. The low volatility stocks, which held up well in 2022, they outperformed the S&P, while they continue to underperform in 2023. Discretionary continues to outperform staples. We saw just the opposite of that in 2022. And then energy was starting to come back up, but then this past week it saw some weakness when we compare it to tech. So when this is going down, that means that tech is outperforming energy. A long-term study, and these are our positive seasonality and setups that I talk about in every daily video, but I only show the videos, or I only show the charts in the weekly video, where we have an NYSE breadth thrust that was triggered back in October 2022, and this is still on the books. Also, we had a ZWAG NYSE breadth thrust that was triggered back in March. That's when this rose up really high. Well, we actually dropped to negative, and I still haven't really found any information on that yet. I guess this is still on the books. If this dropped back down here, I don't know if that really negates the signal or not. When we look at the Zohorchak method, we did have a signal that was generated earlier in 2023. That still remains. This is a long-term chart of the S&P 500 weekly going back to 1987. This is the crash. And then I extended a trend line up to the dot-com bust low. And then we broke below this trend line when we had the great financial crisis. Took us a long time to get back up here. We hit resistance in 2018. Right before the COVID plunge, we hit resistance again. Well, we were able to break through this, and now we've dropped back below it. We're trying to come back up to this trend line, but currently we remain below it. This is a shorter term look at that same chart going back from 2018, 2020, and then where we're at right now. So we're leaning a little bit more towards the negative side. We're also seeing that same thing with the NASDAQ 100. We're underneath this longer term trend line going back to 2009. We also keep an eye on this, a weekly chart of the NASDAQ 100 to Dow ratio. We came up to a really high reading right before the dot-com crash. Took us 20 years to get back. We came up here again right at the end of 2021, right before we started a very difficult 2022. We're coming back up here again. We haven't necessarily matched the previous high, and we might turn around and go back up and actually set a new high, if not at least come out to this previous high. But right now, this ratio continues to decline. This is much longer term. We just want to keep an eye on this from time to time to see how things are developing. Our momentum studies, this is more negative, not because of the trend line when we had the breakout, but looking at the MACD on a weekly chart, we're starting to drop below the moving average. So that's longer term negative. Then Tom Bowley from stockcharts.com and earningsbeats.com, he came out with, in his free email that you can sign up for. He puts out emails every day, but he also has a monthly email. At the end of, July, when I got this, his research says that August is the third worst calendar month. Typically in the month of August, energy is not hot, where it was hot for a lot of the month, and tech is hot, which it was kind of not hot there for quite a while. But we're coming up into the latter part of August where we tend to see some historical weakness. Here's the updated calendar for the week of August 28th through September 1st. We will be getting the second estimate for GDP on Wednesday. The big inflation number this week is going to be the PCE prices on Thursday. And then Friday is going to be important because we get the employment situation report and we get the ISM manufacturing on the same day. You don't see that very often. At least I don't remember that happening that much. Looking at the Stock Traders Almanac statistics for Monday, August 28th, we're neutral to negative with the Dow, where we're neutral to positive with the S&P and NASDAQ. This only applies to Monday's session. This applies to the presidential election cycle, where we should have been seeing a bounce at some point in through the month of August, but we never have really seen that, at least up to right now. This also looks at the NASDAQ, where we came down. We should have seen a bounce in August with the NASDAQ, but it hasn't materialized at least yet. Now, this doesn't mean these things are going to happen. We're just looking at what has happened before and what is historically likely to happen again. It's not playing out that way as of right now. Then we look at the S&P during pre-election years. We follow the green line because that's a pre-election year after a midterm bear market, which is what we had. And we should have seen some kind of a bounce in August, but as of right now, we haven't really seen that. We will be on the 20th trading day of the month, and then I have this other chart where we're past this time where we should have seen a nice little bounce. It's not that we're turning massively negative here during the pre-election time, but we're just kind of trying to figure out where do we go from here during pre-election years. Now, Tom Bowley's research suggests that we go negative. This research is suggesting that we have a positive end going into the latter part of August during pre-election years. So our scenarios, and these only apply to Monday's session. We're going more with the down one because our technicals are negative, but they're showing some improvement. We've got to get above that 50-day moving average. We're not going with the up scenario for right now. None of our charts are suggesting that at the present time. You could possibly go with the sideways trend if you're more shorter term, because the short-term ADX is below 20. It's also below its moving average right now, suggesting that we're in a trendless environment. The warning signs. This is what we saw coming together in the latter part of July into the early part of August. A bunch of short-term bearish signals that came together. This has lasted so long now that we could almost change this to intermediate term. But a lot of these things came together. We hit that overhead resistance, and then we've been having some trouble since that time. The longer-term trend signals on the weekly chart of the S&P and the NASDAQ 100, we're still below those trend lines. That could end up signaling that we're at a top. Seasonally and historically, August is not a strong month, but we're supposed to have some kind of a bounce in here, but it hasn't happened yet. The S&P 500 daily oscillators are negative. We're also watching a NASDAQ 100 daily oscillator. It continues to be negative. The VIX is climbing, but it did decline on Friday. And then we look at the equity put call ratio. It had been spiking up, starting to come back down, but now we're starting to see it turn up. And that moves the opposite. When it's coming down, that's positive for stocks. All of the major indexes that we follow are below their 50-day moving averages. The cumulative new highs, new lows for the NASDAQ are showing weakness. We're above the 3-month yield that we set back in 2007, and we haven't started to turn down yet. If we start to roll over and come down, that's when we're going to wonder if it's generating a warning sign. And then we just deal with earnings season as it happens. The seasonality and setups that I just got done talking about, those are still in the background. The daily special K chart is positive, where the weekly chart is negative. The longer-term equity put call ratio, it has been declining, which is positive for the market, but now it's starting to turn back up. The downtrend channel upper line that I don't show in this video, I'll put that in the deep dive video, we're still above that level. We're still in a risk-on posture on the intermediate term when you look at the daily charts, but short term, we switch to a risk-off posture. The S&P is outperforming utilities, and the Staples S&P 500 ratio is declining. Both of these last 2 points together often give support to the S&P. We're just not seeing that yet. The Russell, the small caps, and the mid caps are working off of recent golden crosses. Small and mid cap growth, even though it's been chopping sideways, continues to be positive. The financial sector, even though it's been getting creamed pretty hard lately, it did generate a recent golden cross. The parabolic SAR on the daily chart continues to be positive. So our conclusion, and this just applies to Monday, We are negative, but showing some improvement. We're saying that same thing for the short term and the intermediate term, where we're still positive in the long term. One last chart. Going back to 1950, we're up and down 50% during pre-election years for the S&P 500. Thank you. I really hope you found this helpful. Please feel free to check out the daily video. I'll also be preparing and posting an intermarket analysis video, as well as what I call a deep dive video, where I take all the daily charts that I really didn't talk about that much this past week, and then I do a video just about those to see if we get any insight or information. Have a really good weekend, and I will talk to you in the next video.